So hello everyone, thank you all for coming. Maybe we can wait just another minute to see if the rest of the participants can come in to assist our webinar today. We already have a few people who already are in. I don't know, Francisco, do you want to wait another minute or should we just start?
Well, I believe perhaps another minute couldn't hurt to see if we have more participants joining in.
Okay, let's wait a little bit then.
Yeah.
Thank you for waiting. Okay, we have another one. So maybe we can start just so the people who already are here won't have to wait much longer. And we can just go slowly. I would like to start by thanking you all for coming, of course. My name is Marta. I work for Finpartner. Today with me we have Dr. Francisco Furtado from Martinez-Echevarría Rivera law firm. I don't know if I pronounced it correctly.
Perfect.
Great. So today we will be talking about tax representation and moving to Portugal. I will start with a brief introduction about tax representation, where I will explain what it is and who needs it. And after that, Francisco will go after me and talk a little bit more about moving to Portugal and other topics related to that. We will be answering questions, but we will be answering them at the end of the presentation. So if you have any question, please feel free to ask them on the chat, and we will be looking at them and answering as many as we can after the presentation. So let's start the webinar, should we? Again, like I said, I work for Finpartner, which is a firm that is specialized in accounting, taxes, consulting services, both on a national and international level for individuals and companies. The topic today, tax representation, is the main responsibility of our immigration desk, which is my department. And I would like to start by briefly explaining what is a tax representative. So a tax representative acts as a mediator between the non-residents and the Portuguese tax authority. We have the responsibility as your tax representative to assure that you fulfill all of your duties to the Portuguese tax authority, such as getting a NIF for non-residents, handle their taxes, keep documents that prove your expenses, your incomes, provide clarifications and answer before the tax authority, and so on. And very important, in order to be a tax representative, it is required to have a permanent resident address in Portugal, because we will be the ones in contact with the tax authority, as well as receiving your Portuguese correspondence and some other obligations we have to do. Now, I would like to, like I said, I'll talk about a few topics that may not be very, how do I say, you may not be familiar with it. And the one I said, NIF, In Portuguese, we call it NIF. It's actually the taxpayer number here in Portugal. It is a unique number formed by 9 digits and is assigned to individuals for tax purposes. So all the Portuguese people have a NIF, and you can find it in our ID cards, as you can see in the sample in the PowerPoint. And so according to the Portuguese law, those who wish to have affairs in Portugal, for example, open a bank account, write a contract, purchase property, and so on, will need a NIF. And this is where the relationship between you, the non-resident, and us, the tax representative, starts. Because the NIF is an obligatory element that you need to have. And if you are a non-resident, you will need to be appointed to a tax representative, and only then your tax representative will be able to get you a NIF. So let's talk about who is considered a non-resident. And this is very important, because to be considered a non-resident, it doesn't matter if you have a resident card or if you're a Portuguese or not. We can vaguely describe non-residents as those who do not live in Portugal. But not only those who do not live in Portugal are non-residents. Actually, anyone who leaves the Portuguese territory for more than 6 months to any country outside of the European Union will be considered non-resident and will need to appoint a tax representative. So, we Finpartner, most of our clients are non-residents, and because of that, we have a lot of experience in many countries. Some of them, I would say most of them, are from the Asian market, but nowadays we have receiving a lot of clients and a lot of requests for services for countries like America, for countries in America and in Europe as well. And now I hope this is not a lot. I'm trying to just do a brief representation, so I don't want to confuse you too much. But I would like to talk a little bit about our taxes and the definition of a taxpayer here in Portugal. First, we have 2 types of taxpayers, those who live in Portugal and those who do not live in Portugal, but have an income from activities based in Portugal. So putting it simply means that as long as you have an income in Portugal, no matter where you live, Portugal or not, you have to fulfill your taxpayer obligations. So those who live in Portugal are the residents, and those who do not live in Portugal but do have an income in Portugal are the non-residents. And it's a note that I'd like to tell you is just like, as a resident, you need to declare your incomes from Portugal and from outside of Portugal. But as a non-resident, you will only need to declare the income you obtain in Portugal. So there are a lot of differences between residents and non-residents. So talking a little bit about tax obligations in Portugal, since they are a little bit complex because there are many of them for today, and since most of our recent clients are Golden Visa immigrants, I will just expose some of the tax obligation when you choose to buy or to rent a house, for example. For starts, when you're buying a house, you'll need to pay for IMT, which is a property transfer tax, plus the stamp duty. Now, IMT is a tax that can go up to 6.5% on the property purchase price. In other hand, the stamp duty can go to 0.8% of the same property purchase price. Both of these taxes are only paid once on the moment you purchase the property. After that, we have the IMI, or like we say in Portuguese, IMI, which is the property tax. Now, this tax base is calculated by the taxation department according to the building value, the lot, the area, if it's old, if it's new, and other elements of each square meter. It has nothing to do with the market price. It has nothing to do with rent, property fees, and so on. This tax can go between 0.3 to 0.5% on the property tax value, and it's paid annually. It also means that since it has nothing to do with the market price, but it has to do with his value, for the property value, this means that as long as the property value changes, because it can change due to a lot of different elements. And if this value changes, then your tax base may also change. There are also other important taxes, but to buy or rent a house, these are the most important ones. The others, I won't be talking about them today because it is enough content for another webinar, and it will run away. It will be a little bit different from today's main topic, so I'll leave that for another time. And now, like I said, it's really briefly, so I'm almost done. As you can see, I'll just like to do a little review. Our job as a tax representative is described, like I said in the beginning, as a mediator between the non-residents and the Portuguese tax authority. But notice that a tax representative responsibility does not end with signing a paper and getting you a NIF. It goes way beyond that. So there are a lot of complicated obligations that you need to fulfill to the tax authorities, from declaring your activities, your incomes, your expenses, submit different declarations and forms, and keep you update of the tax payments and the time and what happened if you don't do it right or if you fail the time limit, and so on. So we in Finpartner make sure to give our clients the best service we can. That's why we find it very important to have people who can talk different languages, because we wish to give our clients a service where they can understand in their first language. For example, we have already established an English, a Spanish, a French, and a Chinese desk. This means that we can give you services in all these languages. And I do believe that Dr. Francisco maybe will agree with me that the Portuguese law may not be very, how do I say this? I don't want to say stable, but it's the only word I can find for now. What I mean is that, especially now during the pandemic, our laws and regulations, it's changing. I mean, it's suffering updates every now and then. So daily we have new ways to do things, new laws to abide by, and it's very important to have people who can understand these changes and that can give to our clients the information on time. For example, if something changes today, we need to update our client right away so it doesn't cause trouble for them or for their business or for anything else related to that. I would like to say, of course, that our company, our collaborators are all professionals, and at the same time, we work with many partners that can help us provide the best services. And this is our main job as your tax representative. And now I would like to give word to Dr. Francisco to keep the presentation, to continue the presentation. Please go ahead.
Thank you, Marta. So my name is Francisco, as Marta said. I'm here today to give you a brief presentation about the advantages of moving to Portugal. Well, as Marta has pointed out, there are indeed several advantages that are foreseen in our tax law for foreigners that are just wanting to re-domicile to Portugal or to invest in our country. So for today, we have prepared a presentation focusing in one personal income tax advantage and one corporate income tax advantage also. So I believe that all of you have heard of the ANHR program, that despite the name and the naming of this program was really bad, because it feels like that non-habitual tax resident, it's someone that is not a tax resident. That's on the contrary, it's upmost, it's and foremost, it's a tax resident in Portugal, but it will be a tax resident in Portugal with a special status. The preconditions to be eligible for this regime are apparently quite simple, and are the ones that are described in the slide that you have in front of you. So you cannot have been a Portuguese tax resident in the previous 5 years. You must become a Portuguese tax resident, and you must file the ANHR claim up to the 31st of March of the year following the one that you become Portuguese tax residents. However, we must analyze a little bit further each one of these preconditions in order to be sure if we fulfill every one of them. First, regarding not have been a tax resident in the previous 5 years. We need to emphasize that citizenship is irrelevant. Last tax residency jurisdiction is also irrelevant, meaning this is a global and worldwide program, and in theory, everyone is eligible, meaning that Portuguese people that have went abroad to work for more than 5 years and now they are willing to return, or foreigners from any point of the world are eligible to this scheme. One thing that we need to be careful about is tax residency presumptions. In the Portuguese law, although someone is not living in Portugal and not fulfilling all the tax residency preconditions, they may be deemed as one. One of the examples that we have, if someone is living in Portugal and then moves to a tax haven, let's say it leaves Portugal and goes to Monaco, goes to Andorra, goes to Turks and Caicos, so a blacklisted jurisdiction, the Portuguese authorities will deem you as a tax resident for the following 5 years, unless you can prove that your redomiciliation abroad was due to economic reasons. Namely, you have an employment agreement or equivalent proof to show that it was not just a tax-based decision. Should we fail to prove this, what it means is that although we have left Portugal for more than 5 years, we must take into account this assumption. And so we will have not only the 5 years that the regime foresees, but also the 5 years that the assumption that the law assumes you as a tax resident, meaning in the end of the day, it may be up to 10 years in these specific situations. It's not, I would say, something that we see on a daily basis, but it's quite often because our blacklist of jurisdictions, it's quite wide. And so many times, especially with Dubai, because the Emirates, although there is a double tax treaty in force, they are still blacklisted. And so we need to have some cautions when we analyze if someone is eligible for this regime, especially if in the past you were a Portuguese tax resident. This also happens a lot, if you allow me just 30 more seconds on this topic, for people that somewhere in the past have bought a home herein for vacations, and this happens a lot in the Algarve area, and now, 20 years later, you are deciding to move to Portugal to live permanently, and you realize that at that moment, someone registered you as a tax resident. This is quite often happening, and so in these cases, what we need to do is to dispute your previous registration retroactively, and the key document to do so will be a tax residency certificate issued by the jurisdiction where you were living under the double tax treaty. So this is the key document and the most important one to dispute previous wrong registrations. Regarding tax residency, and as Marta pointed out, tax residency, it's not something, although it's a registration, is not something that you may choose. It's something that is a status that rises from your personal circumstances, from real life. And we need to be careful because Portuguese residents are liable for taxation on a worldwide basis, meaning that you have to disclose to the Portuguese authorities all your income, regardless of where it is sourced. And this is a key element when you make the decision to become a Portuguese non-habitual tax resident, because this means that you have to disclose to the Portuguese authorities all your income, regardless if the money flows to Portugal, regardless of where it is sourced. Regarding, I'm sorry, I failed the button. Tax residents, in order to be a tax resident, there are mainly three preconditions that I would say we should only emphasize the ones in paragraph A and paragraph B, because the last one, it's quite specific. But I would say there are two major rules. Or you are physically in the country for more than 183 days, roughly 6 months and 1 day. Please note that this test is done not in the calendar year, but in any 12 months period. And this is very important. Or if you are less than 183 days in the country, you have a dwelling in such conditions that one may assume that is your permanent inhabitation. So if you have your family living here with you, you don't have a home available elsewhere, regardless if the house herein is owned or leased, that's irrelevant. But what is important is to prove that your primary home is in Portugal. And should we prove that, you will be deemed as a tax resident. Please bear in mind that when we analyze these conditions, Portugal will never dispute your tax residency because, well, as we have said, you will be liable on a worldwide basis. So we are attracting taxation to Portugal. So Portugal will never dispute your tax residency. Who may dispute, it's your previous jurisdiction. And for instance, for those coming from the UK, HMRC have the sufficient ties test. The French authorities have also similar tests, so that they will try to deem you as a tax resident in those jurisdictions so they can tax you accordingly. So the problem will never be in Portugal. It may be in your home jurisdiction. Finally, the last preconditions to become a Portuguese tax resident is to file the claim. This claim must be filed electronically, meaning that you need to ask for your personal passwords in due time, so you can, until the 31st of March of the following year, you may file your claim to become an HR. It is very important to fulfill this deadline, because if you miss it, the status will be compromised forever, because in order to fulfill again the precondition of not have been a Portuguese tax resident in the previous 5 years, you must leave the country, wait 5 years, and then come back. So it is very important to have this deadline in mind and comply with it. Advantages. I would say there are 3 levels of advantages in this regime. First, for salaries, if you perform a high added value activity, and there is a list of high added values activities such as engineers, designers, software programmers, medical doctors, the list is quite wide, you benefit of a 20% flat tax rate for salaries sourced in Portugal. If the source of your salary is abroad, then you will be exempt in Portugal, provided that you can prove that there was some taxation abroad. For instance, if your source of income is the Emirates, Dubai, for instance, then since in Dubai there is no, or in Hong Kong there is no taxation over salaries in the Portuguese sense, what will happen is that your salary may be taxable in Portugal should we fail to prove the taxation abroad. Because regarding salaries, our law foresees that the salary to be exempt in Portugal, it must have been taxed in the other jurisdiction. So this is very important regarding salaries. Then we will have a second level of exemptions that are foreseen for pensions. Pensions now have two regimes, in fact. If you were registered in Portugal as a Portuguese tax resident before the 1st of April this year, you can choose between being exempt or having the new regime applicable. In the new regime, you will have a reduced tax rate of 10%. Well, you can ask, and it's fair enough that you do, why should someone opt to be taxed if an exemption is available? Well, what happened is that, as you may know, some Scandinavian countries, mainly Finland, Sweden, and somehow Denmark also, they have a complaint about our regime, because a lot of their citizens were moving to Portugal and having their pensions here, and so they would not be taxed. They would not be taxed at source because the double tax treaty says so, and they would not be taxed in Portugal because our regime says so. And so they start all kind of legal arguments saying basically that double tax treaties are enforced to prevent double taxation, not to grant double exemption. That would be the case. And so in order to, I would say, dismiss all those complaints, Portugal has amended our regime, foreseen a new tax rate of 10%, that it's mandatory for all the ones that are registered after April 1st, in order to, so those taxpayers are able to prove that they are paying taxes in another jurisdiction. So if you are coming from Sweden, if you are coming from Norway, you may opt to have this 10, or even France, because France had a different approach because they went through courts, but in the end of the day, the result was the same. You may have an advantage on proving that you are paying 10%. That is a fairly reduced tax rate and lower than the ones that are enforced in those jurisdictions. And so with that, your home tax authorities cannot argue that you are not paying taxes anywhere. Then, lastly, we'll have the exemptions that are foreseen for the last categories of income. Those categories of income, it's self-employment. Self-employment, it's exempt. The exemption is considered provided, again, that you have a high added value activity, and all the other categories are roughly capital income, royalties, dividends, interests, and mainly income from investments. In order for those to be exempt herein, the only thing that we need to prove is that under the double tax treaty, the other jurisdiction is allowed to tax. And this is a major difference, because regarding salaries, we must prove that they were actually taxed. Regarding this capital income, we just have to prove that they are allowed to tax. For instance, with Malta has decided that they do not tax the distribution of dividends to foreign shareholders. But those dividends can be received in Portugal, exempt of taxation, because under the double tax treaty, they are allowed to tax. They just have opted not to. So it is, we can structure, it's possible to structure one's portfolio in quite an efficient way using this kind of these jurisdictions that allow us to have, in the end of the day, a double exemption. And please note that Malta is not a blacklisted jurisdiction. So Malta, it's within the European Union, fully compliant for all tax purposes. Red flags regarding this regime. One thing that, well, I did not say it in the beginning, but it's never late to emphasize that the NHR regime is not a one-size-fits-all regime. You really need to analyze carefully your portfolio, your source of income, your investments, to see if it fits you and if it suits you. For instance, capital gains on securities are, as a general rule, fully taxable in Portugal. Meaning that if your activity is to be actively on the market, buying and selling shares, or your retirement plan is to sell your company in your home jurisdiction and move to Portugal, should you do it as a Portuguese tax resident, you will be fully taxable, and the tax rate is 28%. So regarding, if someone has a main portfolio regarding securities, we should adapt and perhaps have a holding company in between, so that the Portuguese regime may be efficient. Real estate related income rising from properties located abroad are, as general rule, exempt in Portugal. So you may keep your house in your home country and perhaps rent it to have some income, and that income will be taxed at source and exempt in Portugal. One thing that we need to be careful is the permanent establishments situation. Permanent establishments, I would say, it's an assumption. It's a legal status that allow governments to attract taxation to their home countries that otherwise would not be taxed. So if you have a company abroad, or if you are abroad, but with pursuing an economic activity in Portugal, you need to be careful if you have a permanent establishment in Portugal or in the other jurisdiction, because this situation may raise some obstacles to benefit from the tax exemptions. And it's something that it should be analyzed on a case-by-case basis, because there is no general rule. We need to analyze your personal circumstances, and if you are or not a permanent establishment here or abroad. Two last warnings. First, the tax, in order to be efficient, your income cannot be sourced in a tax haven. So in the government listed in the Portuguese blacklist, for those sources, they will be fully taxable in Portugal. And foreign sourced pensions are not necessarily pensions for Portuguese income tax purposes. Portugal has a fairly narrow interpretation of what it is a pension. We see, especially with clients coming from the US, Canada, UK, that there are a lot of financial products that are sold, that they were built as pensions in those jurisdictions. It's something for your retirement, but they are not necessarily a pension for Portuguese purposes. And so it's very important to analyze how the so-called pension is structured, to see if it is a pension. It may be framed as a pension for Portuguese purposes, or if it is, like sometimes it is, a capital income. For instance, with the UK clients, there are a lot of pensions that you are allowed to draw down 25% as a lump sum in the beginning, and then you are just taxed on the remaining. Those 25% usually are fully taxable in Portugal, because they are not deemed as a pension, because you are receiving it as a lump sum, and pension for Portuguese purposes is more an annuity than a lump sum. So we need to be very careful about those situations. For corporate tax, just to give you, Portugal has few regimes that are quite attractive for investment. One of them is our participation exemption regime, that it's, I would say, more attractive than some other regimes that we find in Europe. Well, I would say the most famous one is the Netherlands, because it was mainly the first. But in Portugal, you can have more benefits from this regime than you have in the Netherlands, especially because the timeline of the holding, the percentage of the holding is less demanding herein. Moreover, this regime is applicable for all companies, provided that they are not just partnerships. It will not be applicable to partnerships, and not necessarily to holding companies. So you may have an operational company in Portugal that simultaneously you can use as an operational company and as a holding company, in the sense that you use it to receive dividends from abroad, in such a situation that they will be exempt in Portugal. This can be quite efficient if you make use of the wide range of the Portuguese double tax treaties, especially the ones that we have with African countries such as Angola. That there are not many countries that have a double tax treaty with Angola, and because in the end of the day you can expatriate your dividends to Portugal with no taxation at source and no taxation herein. And so it's quite efficient to have a scheme that you can accumulate your wealth in a European safe jurisdiction with no further taxation. Furthermore, this regime is also applicable to the Madeira Free Trading Zone companies, meaning that you can benefit from a 5% tax rate that is one of the lowest in the European economic space, and simultaneously benefit from the participation exemption regime. I'm sorry, I believe I jump. Yes. The preconditions to benefit from this regime are that you should at least own 10% of the shares or voting rights of the entity distributing the dividends, and these shares must be held for at least 1 year. Regarding dividends, it may be less, provided that you do not sell the shares within that year, meaning that you can incorporate today, distribute dividends tomorrow, and as long as 1 year from now you still own the shares, you benefit from the regime. Otherwise, what will happen is that you must pay back to the authorities the tax that was avoided in the first transaction. The second precondition is that the entity, the third, I would say, it's that the entity that distributes the dividends cannot be domiciled again in the tax haven or in a jurisdiction where the normal corporate income tax rate applicable is less than 60% of the Portuguese normal rate. We have several exceptions to this rule, but roughly what you must have in the company that is distributing the dividends must be in a jurisdiction where the normal corporate income tax is higher than 12.4%. And this percentage was not innocent, so it allows, for instance, companies in Ireland or in Cyprus to benefit from this regime towards Portugal because they are just a little bit over the threshold. A warning regarding this regime is that will not be applicable for companies that pursue the activity of buying and selling real estate, or if its assets are in excess of 50% real estate located in Portugal. So this participation exemption regime cannot be used in those situations that you have an operational company. You have, for instance, a holding company in Malta, and then you sell the holding company. You have an operational company that it's owned by a holding company in Malta, and you are the ultimate beneficial owner living in Portugal. And then you cannot sell the company in Malta because their assets would be, from indirect perspective, more than 50% real estate in Portugal, meaning that the ultimate beneficial owner would be, that in this case would be a company, would be fully taxable because this regime would not be applicable. So, but regardless these situations, the regime is applicable. And I would say from a very it's a summary of the benefits that you may find in Portugal. There are several others, especially regarding investments and that involve academic and scientific analysis, that involves industrial property. So also Portugal may be a good jurisdiction to park your investments and to benefit from an attractive tax regime. Well, thank you for your time, and I would say now we are available for all your questions.
Yes, of course. Thank you, Francisco. So if you have any question, please feel free to write it in the chat and we'll be answering them. Of course, go ahead. believe it would be easier if you could write it, if that's not much a trouble for you. Looks like we have a lot of questions. Be ready, Francisco. Francisco, I believe you're most suitable to answer that question.
Okay, so perhaps we can start by the first question. I believe that there are some questions that will follow. So regarding the question that you are raising, and thank you for it, I would say, as we have said, the preconditions are just that you have not been a Portuguese tax resident in the past 5 years. If a taxpayer abroad, you sell the shares of a Portuguese company, that will not have any interference in your eligibility to the NHR. What will happen is that, as Marta has said in the beginning, you will be a non-resident with an income sourced in Portugal, because the company that you are selling the shares of is domiciled herein. And so there will be taxation in Portugal. There will be the need to fulfill filing obligations and most likely tax-paying obligations herein. But afterwards, or before, as you wish, you feel more suitable to you, you may apply for the NHR, provided that in the last 5 years you were not a Portuguese tax resident. As I understand, you have a family member that works in Portugal, and well, at least he holds a position in a Portuguese company. In Portugal, tax residency is analyzed, I would say, since 2014 or something like that, from an individual perspective and not from the family perspective. The family perspective, it's important to ascertain where one have the central vital interests, but just for that. So even if your husband was a tax resident herein, provided that you were not, your situation will be analyzed individually, and the preconditions will be analyzed individually to you. And so you are fully eligible, I would say, under the assumptions that we have in your question. I would say you will keep your right to be and apply for the NHR regime in the future, even if your husband is a tax resident already.
Thank you, Francisco. I hope that answered the question. If you still have any doubt, please feel free to ask.
Okay, but not a tax resident. Okay, perfect. Even if you own the house, but none of you is a tax resident, perfect. So you both are eligible for the NHR still.
Anyway, yes, please feel free. You have Francisco email in the PowerPoint. We can also write it in the chat, my email and Francisco as well. And if you have any question that you want to ask, or you want to hear more in detail, or if it's a more complicated situation, please feel free to ask us, send us an email, just say it's a question from the webinar, and we will try to answer it as soon as we can. Yeah, please. Sure, of course. Go ahead.
Okay, regarding salaries. Regarding salaries, the first question that we need to analyze is where the salary is sourced, because and that's the key element to answer your question. Because if so we have another element. Okay, they are sourced in Portugal. If they are sourced in Portugal, you have, I would say it's quite straightforward. If you are a Portuguese tax resident with a salary paid by a company in Portugal, Germany has nothing to do with it. So all income that you have after you give notice to the German authorities that you have left the country for tax purposes and now you are registered in Portugal, there is no connection with Germany. It's a Portuguese domicile paying entity with paying income to a Portuguese tax resident. If you are the beneficiary of salaries paid by a Portuguese company, and as a German taxpayer, then we will have to analyze the double tax treaty, because you have a source jurisdiction and a residency jurisdiction. I'm speaking by heart, but as far as I remember, the general rule is that the tax is paid at residency jurisdiction. However, provided that the activity was not performed abroad. So, and that it would be something that we should have to analyze, even if the German authorities do not accept that it's center of temporal. Of course. Well, that's another situation. I was assuming that you were moving to Portugal and giving notice to the authority. What can happen with in that situation is that, for instance, if you registered yourself in Portugal as tax resident, but you are still living in Germany, or you spent a lot of time in Germany, that kind of dispute may rise. If it rises, what will happen is that we will have to use a procedure that is foreseen in the double tax treaty, so that the authorities will agree on where you are a tax resident. The tiebreakers for the tax residency in the tax authority, in the double tax treaties, are roughly, first, where you spend more time. If you spend more or less the same time in both countries, it's where you have a home available. If you have a home available in both countries, it's where your center of vital interest is. If it's not possible to ascertain where your center of vital interest is because, well, you have social life and work life in both countries, the last one is citizenship. If you are a citizen of both countries, then the tax authorities will have to agree upon themselves where you will be deemed a tax resident. So, but I would say for the German authorities not to accept that you are no longer in Germany, I would say what would have to happen is that you are spending a lot of time in Germany, and probably you are keeping a house there that it's not being used for commercial purposes, so it's just available to you. If that's the case, then the risk exists that we may have a dispute with the German authorities. I never had. For all my German clients, I've never seen a dispute from the German authorities. I've seen it from the HMRC a lot, and from the US, the IRS. The IRS is quite active in this sense. But with the German authorities, I never, or German, Swiss, Italian, I never had any problems. Let me see. Well, it depends. And it depends on two grounds. First, if the Portuguese authorities accepted that the power to tax is given to Germany or not. or if it was just a Germany unilateral decision. And I would say the major risk is that the deadlines to ask for reimbursements are fairly small. In the best case scenario, you have 4 years. I would say from the moment that the dispute arises, all the procedures to solve the dispute in both jurisdictions, most likely in the end, you have missed the deadline. And I would say that would be the major danger, to have a full reimbursement. Should you have paid taxes in a jurisdiction that would not have the power to tax. So my advice in these situations, although it's a little bit more complex to manage, but it's when a dispute rises, is not to pay the tax, to file a guarantee to suspend any enforced collection procedure that may exist. So by doing so, you will keep your right to, at the end, to not be reimbursed, but not have to pay. Because regarding reimbursement, I would say the challenge will be to fulfill the deadlines, the procedural deadlines that you have available. Please do, whenever you deem it necessary. Thank you.
Right. So I think if you have any more questions, please feel free. I don't know if you still have any. Either way, like I said before, you can ask them through email. Francisco's email is already there. My email, I will write it down for you. You can also email me to ask any questions you may have. I believe Francisco is also available to answer your questions anytime. So please feel free to send us an email. Either way, even if you have any other topics that we would like to discuss, you can also send us an email and say that, like, I would like to talk about and this kind of topic, and we will try to arrange it if it's possible. So then I believe we can finish our webinar for today. I think it was really useful. I learned a lot from you, Francisco. Thank you so much.
Thank you. Likewise. Thank you so much.
It was really nice. And I hope we can do it again sometime.
Hopefully.
So, yes. So like this, I would like to end our webinar for today. Thank you very much, and see you maybe next time.
Thank you so much for your time. Thank you, Marta.
Thank you.
Bye. Bye.